Now, as we established earlier, that financial assets can be grouped into two. That's investment in debt instruments and investment in equity instruments. Let's look at investment in debt instruments. What then is a debt instrument? A debt instrument can be bonds, debentures, treasury bills, and other views. There are a lot of debt instruments. But for the purpose of this video, an example can be bonds, can be debentures, can be treasury bills. So the standard requires that a financial asset, debt instrument, should be amortized or can be amortized when the following conditions are met. So a debt instrument, that means the following two conditions must be measured at amortized cost unless the asset is designated at fair value through profit or loss under the fair value option. Let's take note of this. An entity has the option to opt for fair value through profit or loss. But where the entity does not, a debt instrument should be amortized when these two conditions are met. The first condition, which is the business model test. The business model test. The objective of the entity's business model is to hold the financial asset to collect contractual cash flow rather than to sell the instrument prior to its contractual maturity to realize its fair value changes. So the first test the entity must pass to recognize the financial asset, which is a debt instrument, using amortized cost, is that the entity, the objective for holding the asset should be to collect contractual cash flow and also to hold it to maturity. The entity should not have any intention of disposing or selling the financial assets within the lifespan of the financial asset. So if it is 5 years, we are holding it to 5 years. We are holding it to maturity for it to be redeemed on the last day. The second one is the cash flow characteristic test. The contractual terms of the financial asset gives rise on specified dates to cash flows that are solely payment of principal and interest on the principal amount outstanding. So the last test, or the second test, is that the financial asset should give rise to the payment of principal and interest on the principal amount standing. The financial asset should result in or should give rise to the payment of principal and interest on principal. Right? So when an entity invests in a debt, that entity is required or has the right to claim the principal amount as well as interest on the principal amount outstanding. So if an entity meets these two conditions, that the business model test and the cash flow characteristics test, then that entity qualifies to measure its debt instrument using the amortized cost. So let's take note of these two conditions. Financial assets, debt instruments can also be measured through fair value through other comprehensive income. A debt instrument that meets the following two conditions must be measured at fair value through other comprehensive income unless the asset is designated at fair value through profit or loss under the fair value option, as I already established that an entity at inception can designate its financial asset through profit or loss under the fair value option. So a financial asset, which is a debt instrument, can be fair value or should be fair value through other comprehensive income when the debt meets these two conditions. Here we have the business model test as well, and also the cash flow characteristic test. Let's take note, they are not the same as with amortized cost. So let's look at why they aren't the same. They are not the same. The objective of the entity's business model is both collecting contractual cash flow and selling financial assets. This means the entity will hold the instrument for its contractual cash flow, but can also sell it if need be. So with the business model test, according to the standard, under fair value through other comprehensive income, an entity has the intention to collect contractual cash flow, but also has the intention of selling the financial assets. When the entity feels it is more profitable to sell, so the entity has the option to hold it to maturity, but also has another intention when it finds it favorable to sell. So as opposed to amortized cost, with the business model of amortized cost, the entity has the intention to collect contractual cash flow and also to hold it to maturity. But with fair value through other comprehensive income, the business model test tells us that the entity has the intention to collect contractual cash flow, but also has the intention to sell it if the need arises. With the cash flow characteristics test, is the same thing. Nothing changes between amortized cost and fair value through other comprehensive income. So we should give rise to the payment of the principal and interest on the principal amount outstanding fair value through profit or loss. Thank you very much.